Hello, my name is Nelson Anthony Richardson, and I'm going to be reviewing microloans for Business 501, Law, Ethics, and Social Responsibility at Eastern New Mexico University, and for Dr. Frederick Green. First and foremost, I'd like to start out with an agenda. Today we will be reviewing a microloan, the history of microloans, some new types of microloans that we see here within the United States, the ethical implications of both, who is specifically at risk from this predatory lending style, and what protection is available to consumers in the form of the Truth in Lending Act and the Dodd-Frank Act and Consumer Financial Protection Bureau. In addition to that, we're going to be taking a look forward to find a way forward. So what exactly is a microloan? In the most basic terms, a microloan is a loan of small dollar amount typically used to help small businesses grow. Microloans are increasing the number of entrepreneurs within the United States. The United States Small Business Administration, which was founded in 1953, has recently gained popularity since the financial crisis of 2008. The agency has been quite busy. As you can see, they provide loans up to $50,000 to help small businesses and certain non-for-profit childcare centers start up and expand. The average microloan is about $13,000, and it provides funds to specially designated intermediary lenders. These intermediary lenders are non-profit, community-based organizations with experience in lending as well as management and technical issues surrounding and related to microloans. These intermediaries administer the microloan program for the eligible borrowers and not the lender himself. The history of microloans. Muhammad Yunus is synonymous with microloans. He is an economics professor from Bangladesh, and he became very frustrated by the cycle of poverty within his home country. He knew that in order to break the cycle of poverty, he needed to provide small business owners with monies to jetpack and start their business flourishing. His first loan was issued in the early 80s, and it was an amount of $27 to local women who wove bamboo stools. This small loan provided them the opportunity to build and buy their own material, and they eventually repaid the microloan and began to flourish as a small business. It was not until 2006 that Dr. Yunus received the Nobel Peace Prize for his efforts in supporting the fledgling business owners who were too poor to qualify for traditional bank loans. The new microloan. Payday loans, also called payday advances, salary loans, payroll loans, small dollar loans, short-term or cash advance loans. These, like microloans, are a relatively small amount of money lent at a high rate of interest, but this is on the agreement that it will be repaid when the borrower receives his next paycheck. Consumer advocates and lawmakers are urging low-income citizens and consumers to avoid these payday loans. This is something that we will review in further detail in a few slides. These are just some advertisement examples from payday loans. As you can see, consumers are promised the ability to get up to $1,000 within 24 hours, and if a customer needs cash, he can do so without any credit, and one advertisement even promises an additional $100 for taking out a loan. What are the ethical implications of these microloans? Primarily, is it ethical to earn profit from poor people? Microloans have an annual percentage rate higher than those typically offered by banks. On average, the rates range from 12% to 18%. Payday loans, on the other hand, have an exorbitant 391% annual percentage rate, and they are given to borrowers without consideration of their ability to pay back such a loan. Do we have an ethical responsibility to avoid harming people in the process? Yes, the answer is absolutely yes. However, it may not be popular as it may reduce a company's profitability. And do microloans really help? Microcredit has the proven ability to hurt a lot of poor people by over-indebting them. Who is at risk? Both microloans and payday loans target the economically disadvantaged. In the United States, communities of color are heavily targeted by both storefront and online payday lenders. Studies have found that race and ethnicity are the leading factors in determining payday loan locations, with high concentrations in lower income and largely minority communities. This targeting, coupled with the high percentage of communities of color that do not have access to traditional banks, creates a financially stressful combination where vulnerable borrowers have few options. Consumer Protection Laws. Truth in Lending Act. The Federal Truth in Lending Act, also known as TILA or TILA, and its implementation of Regulation Z, require lenders to provide borrowers with standardized and understandable information concerning certain terms and conditions of their loan and changes in the terms of their loans. Dodd-Frank Act and Consumer Financial Protection Bureau. Dodd-Frank Act mandated the establishment of the Consumer Financial Protection Bureau, also known as CFPB. From this, it made companies, as well as the Dodd-Frank Act, to adopt rules prohibiting unfair, deceptive, and abusive acts or practices within the consumer financial market. These are also known as UDAAP. Let's take a further look at UDAAP. CFPB studied certain types of loans made within the consumers facing liquidity shortfalls, including payday loans, vehicle title loans, and certain types of installment loans. These loans were determined to trap borrowers in debt that they could not afford. These practices included, but were not limited to, allowing borrowers to roll over short-term loans, aggressively pursuing borrowers for outstanding debts, seizing cars pledged as collateral, imposing penalty fees on borrowers who miss payments. This additionally triggered involuntary account closures as a result of rejected debits by online payday lenders. A way forward. There is not a one-size-fits-all solution to this ethical dilemma that consumers face. Increased regulation, however, should ameliorate the potential violations from lenders. In addition to the increased fees and increased exposure, companies should consider their actions whenever they're lending monies to consumers. All in all, increased education is key to ensure that consumers understand the risks of both microloans and payday loans. Thank you very much for your time. I hope that you have enjoyed this presentation as much as I have had creating it. Thanks.